But happy to move on to the first slide. Thanks, Sonia. And kind of just get in a bit into who I am, what my business does, and why we're kind of here today. So I am on the left in that picture, as you can probably tell, alongside Jake, my business partner. We founded and set up Longstride Capital in December of 2024. From there, we had a focus on effectively providing specialist finance advisory solutions to corporates, individuals, people who kind of wanted to navigate the complex debt markets. And in that small period of time, it's gone from, really from strength to strength. The team has got bigger. We are working on, a load of really, really exciting projects. And for me, my background, even though I did a real estate degree at university, my working life wasn't within real estate finance. I started off in the money markets working for a company called Alpha, which was recently bought, but it landed onto the FTSE 250. As soon as it got onto the FTSE, I decided to leave, always wanted to run my own business and be able to kind of be more involved in the problem solving type solutions, and that's why debt kind of made a lot of sense to me. On the right, you've got Jake, who had a background in mortgages, and through many conversations, we decided to form Longstride. And 5-6 months later, I'm now sat in front of all of you and get to talk to you today. Just thank you, Sonia. Quick kind of to start with on the presentation, I think a lot of people come to me and ask me, why would you even use a finance broker in the first place? Can you not go to lenders direct? And I had an interesting conversation with a few lenders recently, and for them, they have about each lender for bridging development finance. Even when they've got small teams of about 10 people, they're getting 20, 30 different inquiries every single day for people, individuals who have schemes or new projects that they're looking to finance. And ultimately, a lot of it comes down to their risk appetite, what they're looking to focus on and what they're looking to lend on. And each lender has a different risk appetite. Some want to just focus on, ground up development finance. Some want to focus on refurbishments. Some want to focus on the really crazy and wacky. Some want to focus on international buyers, buying London property, focusing on spicy individuals who might, not necessarily, have a credit position or a UK status position to be even able to buy UK property themselves, and so need, additional support getting their funds into the UK. So each lender kind of focuses on different things, and because of that, it can be quite difficult to find a lender that's suited to a particular project. And we've kind of just spent the time focusing on, who the lenders are, what they like, and we're quite grateful to have almost, have met as many lenders as we have, and we've got a really sort of good oversight and overview of the market and understand, who likes what. Moving on to that, we'll also cover a bit on bridging, and I think people always view bridging as an expensive thing to do. Hopefully, I'll be able to convince you that sometimes, it is a risk-reward trade-off, and sometimes that actually you can really benefit from taking a slightly higher rate sort of interest product to work with a lender who is happy to kind of understand the project and work with you to kind of make your vision a reality. And then finally, going into a few finance pitfalls, common mistakes that we've seen, at least, that developers have made, or people looking to bridge particular properties, and hopefully I'll be able to share those with you, so going forward you don't make the same mistakes. I created this slide just to discuss expand on that final point of bridging not necessarily being the most expensive option. I'll kind of take all of these points in my stride and go through them one by one, but bridging allows you to take advantage of opportunities in the market that you might not necessarily be able to to afford with cash. So often we see a large part of our business, at least, focuses on auction properties, for instance. With auctions, you don't necessarily have the time to complete, or you've got 28 days to come up with all the cash. Often you need a fast solution, a fast finance partner to help you get there. And if you're contacting Barclays and waiting 3 to 6 months for them to get you onto a mortgage, you'll probably not be able to buy that auction property, and you'll lose out on the deposit that you paid. Prime assets, they move particularly fast, and bridging lets you act immediately. So you're able to secure purchases while these slow lenders are playing catch up. Another point I find quite fascinating is that although bridging is seen as expensive, you actually pay less total interest over the period that you've got a bridging loan. So, you think about taking a facility with a bank. I'll use Barclays again. Don't know why they're getting so much hate today, but if you take a facility out with Barclays, it would be 25 years. And although the interest rate in terms of your monthly payments will be considerably cheaper over a 25-year period, actually it can be quite costly. And so paying less total interest to overall and taking facility for a short period of time over 12 months can just allow you to get access to the assets that you want, so you can focus on flipping projects, focus on doing more. And over that sort of 25-year period, instead of just focusing on one and paying it back for the rest of your life, you can almost begin your property developer journey or your sort of bridging journey, and end up doing 3 or 4 of those every 2 years. So it's that's that. You can also keep deals alive. So typically, I think the first reason bridging was ever even kind of established into the market was to help properties that were in large chains. And so you'd have these estate agents that would have chains. Someone would need to sell their property in order for to have the cash to be able to buy the property they wanted, and deals were falling out of bed because ultimately people couldn't come up with the money that they needed. And so bridging was used as a solution just to fill the gap, over that short period of time, to allow you to gain access to those opportunities and keep certain deals alive. Creative structuring. I think this is something where we as a business have probably excelled most. Typically, when you look at a lender's appetite, your classic bridging case will be 75% loan to value, meaning if you're buying a property for, we'll call it 100 grand, you need to put up 30 grand of the cash yourself able to get it. But there are lots of different creative ways you can structure deals in the way to actually help you come up with that cash amount, to almost alleviate you having to necessarily put any cash into the deal. And so that can be leveraging on properties that potentially a family member has, and borrowing against that to get deposits over a particular time. You could be using crypto, which we're seeing a lot of, where people are leveraging their crypto assets without necessarily selling them. There are hundreds of different ways that we can structure these loans to allow you to creatively come up with solutions to ultimately suit you, the borrower, better, to be able to allow you to create these situations. One overarching theme about all the points I've probably been talking about is speed, and bridging is just faster. Bridging, it can complete in days. We've done deals where from client giving us a call to them having the money, we've managed to complete in 5 days, and that can involve a lot of other professional parties, valuers, lawyers over that time. So it is just a very, very fast process. And if you work with the right lenders who can move fast, and we know them, ultimately you can really seize opportunities in the market. The other point, and this is more targeted at developers, is that ultimately debt in the current market is a lot cheaper than giving up equity in a project. You might have a particular scheme that you're working on where you could sell on sell on half your liability to another equity partner and give away 50% for that cash injection, or you could raise debt against it and not give away anything and just have a bit of interest to pay. And so it's, although that's seen as potentially riskier, debt is far cheaper than equity, and ultimately can be a useful strategy to employ. Flexibility is the other term that goes along with speed that a lot of lenders and brokers do tend to talk about, and I think it is worth its weight in gold. So I'll cover that as well. And you know, ultimately, the terms can be very flexible and can be set up and to suit the borrower. So even if you only need a bridging loan for a 3-month period or a 4-month period, it doesn't need to be rigidly set up where every single time is 12 months. On the flip side, if you need the bridge to or a development facility to go for 15 months, 18 months, 24 months, depending on what you need, we can structure different packages and solutions to be able to allow you to get to that stage. And then finally is this certainty of funding, which I'm sure all the points I've already made cover this, but bridging does give you certainty. And with bridging, it's not like applying for something where you would look as if you were if you were buying a residential property, you would be putting down a mortgage and you'd be a sort of, that's how you would be structuring the purchase. But with a bridge, you're considered the cash buyer. And so ultimately the vendors, these people look favorably on you, and sometimes you can actually get discounts on the properties or the assets that you're buying, purely because you're saying, well, I'm buying it with cash and you'll get the money straight away, and there's not a long process where you're having to mortgage things. And I think a lot of vendors do prefer that, and ultimately you can actually get properties or opportunities in the market slightly cheaper than potentially elsewhere. Thanks, Sonia. Moving on to a wild and wacky case study we did, and you can see the photo on screen. And I'm going to let you all down now. It's actually not in Hawaii. That is just off the coast of Plymouth in Cornwall. It's called Drake's Island. If you know your history, there was Sir Francis Drake who was one of the main architects behind the British beating the Spanish in the Spanish Armada, and that is his island, and there's a lot of sort of historical value to it. And we got approached by a developer who had planning to build a new hotel scheme on there where there were going to be 50 bedrooms. The NGDV of the project was going to be 30 million, and they were in a pretty tough financial position. They needed to urgently refinance the project itself, and they also had a few other sort of parties at play, such as certain people who own shares of the island that weren't on were from countries that lenders don't typically like lending to. So there were just different aspects that made the deal much more complicated. And I think the chap said when we spoke to him that we were the 10th broker that he'd actually gone to with this, and no one could necessarily find a solution in the market. So it was something where we needed to think slightly out the box and really understand how we'd be able to get this project underway. One thing that was clear to us from the start is that a lender wasn't necessarily going to lend a full-on development facility with the planning in its current way. It wasn't necessarily, the architectural plans hadn't necessarily been finalized. Although they had this planning in principle arranged, it was something that was going to take a bit longer to make the scheme as valuable as it was. The actual island itself as well is very profitable as well. So they host many events on the island, festivals, and they were kind of, through COVID, they had a sort of debt facility that they couldn't run these events on the island, so they were unable to service the interest. So that had kind of eaten away at the equity. There wasn't a huge amount that could be done with this island, and we approached quite a few lenders that we thought would have an appetite for it. Engaged in about 6 or 7 different proposals from lenders who all promised the world and said that they'd do it, and every single time there was always a new stumbling block that came out, which made the deal even more difficult to do. But we continued to persevere and get as far as we possibly could with it. And it fortunately all paid off, and hence why I'm talking about it. And so we managed to refinance all the debt at 75% LTV. They have a facility for a 9-month period where over that 9 months they are going to establish the businesses that have been quite profitable recently but haven't necessarily had a set of accounts to show new value to the island, and hopefully with that will increase the value of the island. Once the value of the island is increased, we'll then be in a position to get this they'll then be in a position to basically be able to build the hotel and complete the vision like they were supposed to do. That was a situation where you know it wasn't the cheapest facility that they took on, but sometimes taking the cheapest facility isn't necessarily the best option. And they were faced with either bringing in new equity partners at the time, which would have been hugely costly to them, or taking on a slightly more expensive development facility and having more control over the island, so that they were more involved in the process and hadn't given too much of the equity away. And they chose the debt option, and it looks like it's a project that's gonna work out very, very well for them. Key takeaways to round off, and a lot of this is more kind of vanity about what we can do and how we can potentially help your project. But we've established relationships with over 310 lenders. I spend a large portion of my time going to lender events, meeting up, seeing lenders, finding out what products they have on the market, just to get that understanding that when we do get a case in front of us, we know exactly where to place it and who with. We've got the cheapest lenders in the market, lenders that for a development finance, are beating specialist banks, and we've also got lenders that can gear up higher to limit the amount of cash in. And on the development side, we use different not only senior debt, but we can use mezzanine finance to get to 90% loan to cost and really limit the amount of cash that developers need to put in. There are lots of different ways we creatively structure it, but we have a very strong foundation of lenders there. The second point, and I hopefully the case study covered that as well, is that we do view ourselves as people who can make things happen. We don't give up. As soon as we've got a project in front of us, a borrower who's committed, someone who wants to work alongside us, we invest our own time and also our energy, and generally start to believe in these projects. And so when you start to see them moving in the right way, it seems very, very rewarding. The specialist knowledge point, we did do some qualifications on this. So it's a qualification that not many people have done, but we're now chartered specialist property finance professionals. So from that was an arduous process, but we have the knowledge, we understand the financial modeling, we can price things up, we can see how it is, and really start to understand exactly what you're looking at before we even take it to a lender. So rather than just aimlessly going out to a load of lenders and seeing who will say yes, just modeling it in a way that we think lenders will appreciate to get more likely to get those quick approvals or even those quick no's, not to waste your time. And finally, I think we're quite trusted by lenders as well. Even our sort of limited, smallish time within the market, lenders are liking the stuff that we're passing to them. We structure it in a way that they appreciate, and from that we've got specialist preferred rates that we've got with certain providers as well, and can really find you the cheapest debt in the market, or find you debt that seems more expensive, but at the same time can allow you to get your deal done and move forward in that way. And thank you very much.